If we talk about the king of the rubber business in the Thai stock market, NER has to be top of mind.
Definitely one of the big players.
Yeah, and in an era where, global rubber prices are just all over the place, highly volatile, and the industry faces these really strict environmental rules like the EU Deforestation Regulation, or EUDR.
Big challenges, no doubt.
Exactly. So the big question is, how did Northeast Rubber, NER, actually navigate that storm in its Q3 2025 earnings? And looking ahead, will their strategy to expand into India and build that major factory over in Côte d'Ivoire, will that really deliver sustainable growth?
That's the core question, isn't it?
Today, we are diving deep into Northeast Rubber. Hello and welcome to the Deep Dive.
That's absolutely right. Our mission today, it really requires us to look beyond just the immediate quarterly numbers. We're not just analyzing the result of Q3 2025. We're really dissecting NER's performance under immense pressure, dual pressure, actually.
Dual pressure. How so?
Well, on one side, you've got the classic risk, the volatility of commodity pricing. That's always there with rubber.
Right.
And on the other, you have this increasing global demand for, stringent ESG compliance. The EUDR is the big one right now.
Okay.
So we need to evaluate whether their long-term strategy, which is really driven by massive capacity expansion and trying to diversify their markets, is actually strong enough to achieve margin stability and sustained growth despite these really powerful headwinds.
Okay, let's unpack this crucial context first. For listeners who might know the stock ticker, NER, but maybe need a quick reminder about what they actually do.
Yeah.
NER operates right in the middle of the supply chain, yeah.
Precisely. They aren't growing the rubber themselves, and generally they aren't making the final product you buy in a store.
Like tires or gloves.
Exactly. They are the intermediate processor. They take the raw latex, the field latex or cup lump, from millions of smallholder farmers, and they process it into these bulk, standardized products that global manufacturers need.
So what kind of products are we talking about?
Their core output is intermediate processed rubber. Things like rubber blocks, often graded as STR, which stands for standard tie rubber, and also ribbed smoked rubber sheets, RSS. These are essential inputs for huge industries. Tire manufacturing is the biggest one by far, but also automotive parts, industrial goods, things like that.
So their position means they're this crucial link, right, between the farmers growing the stuff and the huge multinational tire companies, many of whom actually have big factories right here in Thailand.
That's the key. And it means they get squeezed from both sides.
Okay. How does that work?
Exactly. They face these pressure points that really define their profitability. On one hand, they get hammered by volatile commodity prices, which are dictated by global demand trends, what's happening in China, the US, the global economy.
Okay, the price side.
And simultaneously, they are right on the front lines of these new strict ESG rules being imposed by the consuming nations, like the EUDR. These rules dictate how they have to source that raw material, proving it's deforestation-free.
Wow. So price volatility and complex regulation.
Precisely. So the core question for this deep dive really becomes, how successfully can NER transition from being just a high-volume commodity price taker
Moving tons of rubber
to becoming a high-volume, yes, but also a value-added premium processor? Can they maintain volume and improve margins?
Okay, a huge challenge. Let's get straight into the Q3 2025 report card then.
Yeah.
The net profit figure came in at 326.58 million Thai baht. Now, at first glance, that number kind of sets off alarm bells, doesn't it? Because it represents a year-on-year decrease, down 9.48%.
Yeah, nearly 10%.
Which is about 34.20 million baht lower compared to the same quarter last year, Q3 2024.
And that decline, it's almost a textbook example of what happens in a commodity cycle trap. The core reason for that drop, that nearly 10% fall, was the lower average selling price, the ASP. It just followed the global market prices downwards.
So even if they're doing everything right operationally?
Right. When the spot price of rubber dips globally, it immediately cuts the revenue they generate for every kilogram of processed rubber they sell. As a bulk processor, NER can't easily dictate prices. They're price followers mostly. And that weakness, it really hit them hard in Q3.
And their net profit margin, the NPM, that reflects this reality too, right? It settled at 4.85% for the quarter.
Yeah, under 5%.
That seems, well, really tight for a business that needs constant high capital spending and faces all this logistical and commodity risk. How does a low margin like that impact their operational flexibility?
Well, 4.85% NPM is restrictive. It means basically for every 100 baht in sales they make, less than 5 baht actually translates into profit at the bottom line.
Ouch.
Yeah. And that lack of margin flexibility, it restricts their capital allocation choices. It forces them to rely more heavily on debt or external financing for big projects like the huge STR3 factory expansion we'll talk about. Or it simply means those projects need a much longer payback period.
There's always a but.
Right. But here's where their operational structure really provided some necessary compensation. While the ASP, the price per ton, was weak, the company successfully played the volume game.
Ah, okay. So the price was down, but the quantity was up.
Way up. This is the essential counter-narrative for Q3. While the revenue per unit was low, the sheer quantity of rubber they managed to process and sell was impressive. Their Q3 2025 sales volume hit 112,439 tons.
Yeah, over 112,000 tons in 3 months.
Yeah. And that's a truly significant increase, up 14.73% year-on-year. They moved over 14,400 tons more product than they did in Q3 of the previous year.
Okay, that's substantial.
This is the crucial trade-off you see in commodity businesses.
Ah.
High volume growth successfully offset a substantial portion of that ASP decline. The fact that NER can physically move almost 15% more product year-on-year demonstrates two things, really.
Okay, what are they?
First, it shows their operational capacity is robust, and any underutilized capacity they had is being absorbed. They can handle the volume.
Good sign.
Second, it shows there's stable, underlying global demand from their big clients, even if those clients are currently pushing for lower prices because the market allows it.
So the demand is still there, fundamentally.
Exactly. And this volume resilience, it actually pushed their total sales revenue up. It reached 6,727.27 million THB. That's a 9.15% increase year-on-year.
So revenue went up almost 10%, but profit went down almost 10%. That really highlights the margin squeeze.
Precisely. They increased revenue, but the declining ASP just eroded the final profit margin.
That distinction is vital for anyone looking at the headline numbers. We saw revenue growth, yes, but not really profitable growth in that specific quarter. Let's look at the geographical breakdown. Where did all this increased volume actually go?
Okay, the sales breakdown, it reveals they're still heavily reliant on the domestic market. That accounted for almost 3/4, 74.76% of total sales.
Okay.
And importantly, these domestic sales, they increased by a substantial 15.44% year-on-year. That mirrors the overall volume increase pretty closely.
Right. But I think we need to emphasize that domestic here is a bit of a misnomer, isn't it? This isn't necessarily rubber sold for, like, Thai consumers buying things in Thailand.
Exactly right. That's a critical point. This heavy domestic weighting primarily services their key customer segment. Those massive Chinese tire manufacturers who've established major production hubs within Thailand.
Oh, okay. To take advantage of Thai infrastructure, labor, maybe trade deals.
All of the above. Favorable logistics, trade agreements, skilled workforce. So this volume is booked domestically because the sale happens in Thailand, but ultimately it feeds the major global tire supply chain, destined for export markets like the US and Europe.
Got it. So contrast that with their true export sales.
Right. The remaining 25.24% of the volume, classified as direct exports from NER to overseas customers. And that part actually decreased by 6.01% year-on-year.
That export drop is interesting. Does that maybe link to some of the short-term operational risks we heard about? I remember something about shipping issues.
Correct. Good catch. The sources did note a temporary shortage of shipping containers back in late Q2 2025.
Right.
And that caused some export sales, which normally would have been booked and shipped in Q2, to be physically postponed. They got pushed into the Q3 2025 shipping window and revenue recognition period.
Ah, so Q2's pain was sort of Q3's gain, at least on the export line.
In a way, yes. While this fluctuation makes Q3 look a bit better on the export front than perhaps Q2 did, it really just highlights the extreme logistical headaches and, global supply chain bottlenecks that remain a constant factor. They can really influence quarterly performance metrics, regardless of the underlying customer demand.
Okay. Moving beyond the net profit line then, let's drill down into the efficiency metrics, particularly the gross profit margin, GPM. That should give us a clearer picture of their operational efficiency, right? Managing the spread between input costs and selling price.
Absolutely. GPM is really where the squeeze was most visible. Analysts reported the Q2 2025 GPM at 10.5%.
Okay, 10.5%.
Just now, while that was steady compared to Q1, it represented a notable decrease year-on-year compared to Q2 of 2024. And the primary factor driving that drop was higher raw material costs they were dealing with back then.
Okay, so costs were up in Q2.
Right. And building on that, analysts had already anticipated that Q3 2025 would likely mark the lowest GPM quarter for the entire year.
Why that specific expectation for Q3? Especially if, as you said, global rubber prices, the ASP, were starting to fall. Wouldn't falling input costs eventually help the GPM?
That's the critical point about inventory lag and forward contracts, especially in a rapidly declining price environment. Rubber processing isn't instantaneous, right?
No, it takes time.
NER often buys raw material from farmers or dealers weeks or even months in advance. They might use forward contracts or just be working through existing inventory purchased at older prices. So when the global market price for the finished processed rubber starts to fall rapidly as it did heading into Q3, they are forced to sell their output product at that new, lower ASP. But the costs associated with the raw input they use to make that product the latex bought maybe weeks ago at a higher price, those costs are already baked in.
I see. So they're essentially selling cheap rubber that was made from expensive raw materials they bought earlier.
Exactly. That inventory valuation mismatch compresses the gross profit margin quite severely in that specific quarter. It continues until the new, cheaper raw material purchased under the current lower price regime cycles all the way through the production line and into the finished goods being sold. This mechanism makes GPM highly susceptible to the speed and direction of market price changes.
That makes sense. A real challenge for planning. Okay, turning to financial health then. Despite this short-term volatility and the margin compression we just discussed, the balance sheet actually appears to be structurally improving. That sounds positive.
It's a huge positive signal, yes. Their debt to equity, or DE ratio, was noted at around 1.2 times.
1.2x. Is that good or bad?
Well, crucially, this is an improvement from 1.3 times at the end of 2024, so the trend is downwards, which is good. It indicates that the company is relying less on borrowed money relative to its own equity base, its retained earnings. Continuous retained earnings, even with dividends, strengthen that equity base over time, and that's a key indicator of financial prudence. A lower DE ratio gives them greater resilience against future interest rate hikes, and it gives them more flexibility when they need to secure financing for big expansion projects like STR3.
Good point. Okay, let's step back for a moment and look at the bigger picture. The first 9 months of 2025. Does that Q3 softness really define the whole year so far?
Not at all, actually. The 9-month performance paints a much more bullish picture of their overall operational health.
Yeah.
Total volume sold across those 9 months reached 351,412 tons.
Over 350,000 tons.
Yeah, which is a solid increase of 15.95% year-on-year. Nearly 16% volume growth over 9 months is strong.
Very strong.
And despite that Q3 ASP pressure we talked about, the total net profit for the 9 months was 1,489.42 million THB. That represents an increase of over 15% year-on-year.
Wow. Okay, so 16% volume growth and 15% net profit growth over 9 months. That really puts Q3 in perspective.
Exactly. Q3 looks like a temporary margin hiccup within an otherwise stronger that's defined by massive volume growth. We also saw some specific financial line items that provided some crucial support to the Q3 net profit figure itself.
Ah, yes, non-operational items.
Yes, 2 key non-operating gains help buffer the results, and they actually demonstrate pretty good financial risk management. First, they reported a substantial foreign exchange, or FX, gain of 62.33 million THB.
62 million from FX. How does that happen?
That was up significantly year-on-year. It primarily comes from the timing difference between when they invoice their exports, usually in US dollars or euros, and when they actually receive the payment and convert it back to Thai baht. If the baht weakened relative to those currencies during that holding period, the conversion back into baht results in a gain.
So a weaker baht helped their bottom line in Q3.
In this case, yes. The fact that the gain was so high suggests the baht experienced significant volatility or weakening against their main trading currencies during that quarter.
Okay, and the second gain, you mentioned derivatives.
Right. They also recorded a 37.29 million THB gain from measuring derivative instruments.
Okay, can you explain how those gains materialize and why they're important for a company like NER? What kind of derivatives are we talking about?
Well, the derivative gain essentially confirms their hedging strategies were successful. NER uses financial instruments, things like commodity futures or options contracts, to try and lock in prices. They might hedge the price of their raw material purchases, or hedge the selling price of their final product.
To reduce risk from price swings.
Exactly. So that 37.29 million THB gain indicates that their hedges worked as intended, likely mitigating some of the downside risk from those rapid global price declines we saw impacting their ASP in Q3. Now, these gains, while they aren't core operational income from selling rubber, they are essential for stabilizing the bottom line in a globally exposed commodity business like this. And they were necessary to compensate for the lower operating income caused by that ASP decline. It tells us management is being disciplined in its financial risk control.
That's reassuring. Financial discipline is good in the short term, but what really underpins NER's future, or at least their growth story, is this aggressive capacity expansion strategy. We absolutely have to talk about STR3, the third factory expansion. This seems like the centerpiece of their whole long-term vision.
STR3 isn't just, adding a couple more lines. It's a fundamental scaling play. Management is making an immense commitment here. The total capital expenditure planned for this project is 2,059 million THB.
Wow, over 2 billion baht. That's a colossal investment for a company their size.
It really is.
Where is that capital expenditure primarily focused? Is it mostly buildings or machinery?
The investment is strategically broken down. The majority of it, 1,468 million THB, is dedicated specifically to the specialized processing machinery and the installation required for high-volume rubber processing. That's the core tech.
Okay.
The remaining significant chunk, 499 million THB, is allocated for the physical building construction and, importantly, the storage facilities needed to handle the vastly increased flow of raw materials coming in and finished products going out.
Makes sense. And what does this massive investment translate into in terms of actual physical capacity? And crucially for investors, when will we start seeing the impact on their sales volume numbers?
Okay, the timeline looks pretty concrete based on the reports. The factory is projected to be completed around May 2026. That's 2569 in the Thai calendar year. Production should start shortly after that, sometime in Q3 2026.
Okay, so about a year and a half away, roughly, for a production start.
Roughly, yes. And the impact on capacity is phased but transformative. Their current processing capacity in 2025 sits at 515,600 tons per year.
500,000 tons now.
Right. Once STR3 begins its phased rollout, capacity jumps significantly. It goes to 675,600 tons in 2026. That's an immediate addition of 160,000 tons from the first phase.
Wow, big jump.
And then by 2027, as the second phase comes online, the total capacity is planned to reach 835,600 tons per year. That's a massive cumulative increase of 320,000 tons over just a 2-year period, almost a 60% increase from today's level.
Okay, that really puts them on a path to deliver on those long-term sales volume targets management keeps talking about, right? I think they mentioned peaking around 770,000 tons by 2029.
Exactly. This capacity build is essential to hit those targets. But, just increasing volume isn't enough if you're overly reliant on one specific market, especially one that might be vulnerable, like China.
Good point. Which brings us to their critical market diversification strategy, particularly focusing on India.
India is absolutely crucial for them. It's about balancing that heavy reliance on the Chinese market, especially given the geopolitical headwinds and tariff risks we'll discuss later. NER established an ongoing partnership with Indian customers starting back in late 2024.
Okay, so relatively new relationship.
Yes, and management has set a highly ambitious, almost aggressive target for it. India is expected to contribute approximately 15% of NER's total sales volume in 2025.
15%?
Yeah.
From basically zero a year ago. That's a monumental target.
Yeah.
What makes India so attractive right now, and how is NER planning to win that share against presumably local suppliers or other exporters?
Well, India represents a huge demographic and automotive boom. It's rapidly expanding its domestic tire manufacturing sector, its automotive sector generally, and that translates directly into surging demand for raw and intermediate rubber.
Okay, the demand is there.
NER's strategy seems to focus on leveraging Thailand's reputation for quality rubber and, importantly, reliable logistics chains compared to maybe more fragmented domestic Indian supply. To win that 15% share, they're likely offering competitive pricing and, crucially, stable supply assurance. That consistency can be really valuable.
Right, reliability is key.
And success in India provides that necessary geographic and trade diversification. It acts as a buffer against fluctuations tied too heavily to the U.S.-China relationship, which impacts their Thai-based Chinese customers.
Makes strategic sense. Now, beyond Asia, NER is still pursuing that, highly ambitious international expansion project in Côte d'Ivoire. In Africa.
Yeah.
Strategically, why Africa? And what's the latest update on how that's actually progressing? It sounds challenging.
Africa represents a very long-term play. It's about potentially securing raw material sourcing closer to the equator where rubber trees thrive, and also gaining access to emerging African markets eventually. Côte d'Ivoire is, interestingly, the world's largest cocoa exporter, but it's also a significant rubber producer.
Okay.
Management did establish the required legal entity there, so on paper they exist. However, this is really where ambition meets harsh operational reality. Management stated quite clearly that execution is proving highly challenging.
Why? What kind of challenges?
They mentioned government measures, inherent political instability, and regulatory uncertainty in the region. It sounds like the operating environment is just very difficult. They couldn't provide a 100% confirmation on the operational timeline.
That sounds a bit like corporate jargon for this project is stuck, doesn't it? Why would they continue to pursue such a challenging location when Asia, like India, seems to offer so much growth potential right now?
That's a fair question. The strategic rationale for Africa, despite the difficulties, is likely twofold. First, securing raw material closer to the source in a major growing region could offer cost advantages over the very long term, maybe decades out.
Okay, long-term supply security.
Second, they might be aiming to establish a local processing footprint before their major rivals do, gaining a sort of first-mover advantage in West Africa should the conditions eventually stabilize. But you're right, the inherent risk in Côte d'Ivoire, frequent shifts in political power, changing land use laws, bureaucratic red tape, means that any capital allocated there remains high risk. That explains why they're moving cautiously, even if the progress seems slow and maybe frustrating compared to the quick ramp-up they expect in India.
Okay, a high-risk, potentially high-reward long game. Let's talk about raw material stability back home in Thailand, though. That seems much more critical, especially if you plan to crank up production to over 800,000 tons. How does NER ensure they have a reliable input supply for that massive expansion?
They executed a very smart, very forward-looking maneuver here, actually. They signed a Memorandum of Understanding, an MOU, with the State-Backed Rubber Authority of Thailand, or AOT.
AOT, the government body.
Yes. And this MOU is significant. It's for the joint management and offtake of 200,000 tons of rubber per year, and it's under a substantial 5-year contract.
Wow, 200,000 tons a year. That's roughly 40% of their current capacity. That's a huge volume to secure through a single long-term agreement.
It really is, and it serves multiple strategic functions. For RAO, it helps stabilize the domestic rubber market because they have a guaranteed, massive, consistent buyer for a significant portion of their managed output.
Good for the farmers in the market.
And for NER, crucially, it ensures a secure, predictable, and likely preferentially priced supply of raw material, specifically to feed that new STR3 capacity expansion. Predictable input is absolutely the foundation of high-volume, reliable production, especially as they move into these high-compliance EUDR markets that require verified, traceable sourcing. This MOU significantly de-risks their domestic capacity ramp-up.
Very strategic move.
Right.
Finally, under growth strategy, we need to touch on their push into higher-margin finished goods. It's a small part of the business now, but it feels strategically significant, doesn't it? A move up the value chain towards premium.
Absolutely. While their bread and butter, 99% of their business remains bulk intermediate processing, management is targeting 30 million THB in sales specifically for these finished goods in 2025.
30 million. Okay, tiny compared to the billions in revenue, but what kind of products are they?
The products themselves reveal a clear focus. They're targeting commercial and industrial niche markets, not really typical consumer goods. For example, they've successfully launched these durable livestock floor mats. Think tough rubber mats designed for pig farms and cattle farms.
Okay, specialized agricultural products.
Exactly. And they're planning new items along similar lines, like specialized dog floor mats perhaps for veterinary clinics or animal hospitals. This segment, although tiny compared to their 6.7 billion baht quarterly revenue, it's crucial. It's where they test the waters in higher margin, specialized production that requires different specifications, different marketing than just commodity rubber blocks.
So it's like their training ground for learning how to become a premium producer.
That's a great way to put it. It's where they build the capabilities and market understanding needed for that broader transition towards higher value.
Okay, let's pivot now to the external risks, the things that could derail this whole strategy. We have to start with the biggest demand headwind, those U.S. tariffs and the consequent fluctuation in Chinese demand. China still accounts for half their sales, right?
Yeah, this is a classic example of geopolitical risk hitting a company indirectly through its supply chain. China, as you said, accounts for roughly 50% of NER's total sales volume. But remember, that's largely serving the Chinese tire manufacturers who operate in Thailand.
Right, the domestic sales.
Exactly. The risk originates from the U.S. side with the imposition of high anti-dumping and countervailing tariffs on tires imported from China. Specifically, the rates mentioned were 17% for passenger vehicle tires and an even higher 27% for larger truck and bus tires.
Okay, so the U.S. slaps tariffs on tires made in China, or maybe even tires made by Chinese companies elsewhere. Does it affect the tire factories?
It affects the economics significantly. If that tariff is applied to the final product, the finished tire shipped from, say, the Chinese-owned factory in Thailand, to the U.S., that cost inevitably gets passed on, at least partly, to the U.S. consumer or distributor. It makes those tires less competitive in the U.S. market compared to tires from countries not subject to those tariffs.
Okay, and how does that ripple back to NER, who's just supplying the raw rubber in Thailand?
Well, if the final price of the tires made by NER's customers becomes inflated in the crucial U.S. market, then U.S. consumer demand for those specific tires slows down.
Makes sense. People buy fewer expensive tires.
Right. And that slowdown immediately hits the order books of those Chinese tire manufacturers operating in Thailand who are NER's primary domestic customers. Analysts are already flagging this. They're anticipating a potentially challenging second half of 2025. The consensus suggests a possible quarter-on-quarter slowdown in normalized profit precisely because of this potential U.S. tariff effect. It might cause these Chinese clients to delay orders or scale back their raw material purchases, which could lead to lower selling prices for NER again.
Wow, so even though NER is selling the rubber domestically to Chinese-owned factories in Thailand, they are fully exposed to U.S. protectionist policies that are actually targeted at China itself.
100% exposed. They are deeply integrated into a global supply chain that is currently experiencing significant fragmentation due to these trade disputes. It highlights how interconnected everything is.
It really does. Is there any silver lining here for Thailand or NER?
There is, actually, a crucial mitigation factor. The good news for Thailand is that it still retains a tariff competitive advantage over some of its regional competitors in Southeast Asia.
Oh, how significant is that difference?
It appears quite significant based on the analysis. While tires from Thailand might face, say, a 17% U.S. tariff for passenger cars, competitors based in countries like Vietnam or Indonesia are often hit with even higher rates. The reports mention tariffs typically in the 24% to 25% range for those countries.
Ah, okay. So Thailand is still cheaper than Vietnam or Indonesia from a U.S. tariff perspective.
Exactly. That difference of 7 to 8 percentage points helps Thailand remain a relatively more attractive, lower-cost manufacturing base for those Chinese tire makers who are trying to navigate or circumvent the highest U.S. tariffs by producing outside China. This structural advantage acts as a buffer. It should dampen the negative impact on NER compared to what rubber suppliers in Vietnam might be facing, for instance.
That's a critical nuance.
Okay.
Moving beyond geopolitical trade wars, NER had to deal with a very immediate, very physical risk recently. The warehouse fire. How significant was that event, and what was the financial fallout?
Yeah, that was a major operational incident, not something you want to see. The fire caused damages estimated in a pretty wide range, actually, between 200 million and 400 million THB.
Wow, 200 to 400 million. That's potentially more than a whole quarter's profit.
It's a huge number. But the key detail for investors here, and it's crucial, is that the damage was reportedly covered by full insurance. That includes both the physical structure of the warehouse and the value of the damaged goods inventory inside.
Okay, full insurance coverage. That's the most important part financially. So the financial damage is temporary and should be recoverable.
That's the expectation, yes. The company expected to record the actual damage and the accounting loss in the Q3 2025 results. That would temporarily impact the balance sheet assets and potentially the P&L depending on provisioning. But the crucial insurance payout is anticipated to arrive sometime in Q4 2025. So this means the actual long-term financial impact on NER's cash flow and its retained earnings should be minimal, hopefully close to zero net impact eventually. Though, of course, the logistical disruption and the temporary loss of that specific inventory still needed to be managed operationally.
Right. It's still a headache, but not a balance sheet killer. And the fact they had comprehensive insurance coverage, that points back to decent risk management practices, doesn't it?
It absolutely does. Strong, disciplined operational risk management.
Okay. We also noted that small temporary logistical snag, the container shortage, that shifted some sales from Q2 into Q3, That seems pretty minor compared to a massive fire, but what does it signal about the broader global supply chain environment that they operate in?
Well, it signals ongoing fragility, I think. Even relatively small temporary issues like a regional shortage of shipping containers can materially affect a company's quarterly sales reporting and their volume metrics, especially for bulk exporters like NER who ship large quantities constantly.
Right.
The fact that export sales scheduled for late Q2 ended up being booked in Q3 just underscores that managing physical supply chains is still a constant challenge. Things can go wrong. And when you're dealing with thin margins like NER often is, any unexpected bottleneck, regardless of how small it seems, can cause financial headaches, maybe affect customer relationships if deliveries are late, or even cause contract compliance issues. It's a constant juggling act.
Yeah, never easy. Now, we often see NER compared directly with its much larger peer in the Thai rubber sector, STA, Sri Trang Agro Industry. While both are big in rubber, the sources we looked at suggested that NER manages volatility somewhat better. Can we delve into why NER might appear more stable in its earnings sometimes?
Yeah, that perceived operational stability is often highlighted as a key differentiator for NER compared to STO. The sources hint that NER has been able to maintain relatively more stable earnings, or at least avoided the really massive profit swings and volatility that STA has sometimes experienced, particularly linked to their glove business historically, but even in rubber.
Okay, so why might that be?
Well, specific proprietary details of their contract structures aren't usually public. But we can infer a few probable reasons based on NER's stated strategy and customer base. First, NER likely maintains a higher percentage of its sales under long-term, potentially fixed volume contracts, especially with its major domestic clients, those big Chinese tire factories in Thailand.
Ah, so locking in volume commitments.
Exactly. That provides more predictable cash flow, or at least volume, regardless of short-term ASP fluctuations in the spot market. Second, the successful hedging that was revealed by that Q3 derivative gain we discussed earlier, that suggests potentially superior financial risk management practices compared to some peers, or at least effective execution in that quarter.
So putting it simply, if STA maybe relies more on spot market sales, or perhaps has less effective hedging in place at times, they would feel that ASP dipped much more violently on their bottom line.
Correct.
Whereas NER, having locked in volumes with big clients and maybe locking in some costs and sales prices through forward arrangements or hedges, is more insulated.
That's likely a key part of the explanation. That structural difference relying heavily on stable volume contracts with large geographically concentrated clients like the Chinese tire manufacturers in Thailand versus perhaps a more globally diversified customer base or more exposure to the volatile spot market, that structure is likely what shields NER's margins more effectively during downturns. And this perceived stability, this lower volatility than a typical pure commodity player, is a key component of their investment thesis for many analysts.
Very interesting distinction. Okay, let's transition now to what might be the single biggest long-term structural change facing not just NER, but the entire Thai rubber industry, the EU Deforestation Regulation, or EUDR. This regulation isn't just another hurdle, is it? It feels like a fundamental recategorization of how they have to do business.
Oh, EUDR is an absolute game changer. There's no other way to put it. Its core mandate, effective for any company wanting to sell relevant products into the massive EU market, prohibits the import or export of 7 key commodities, including rubber, if they are linked to deforestation or forest degradation that occurred anywhere in the world after December 31st, 2020.
Wow, retroactive to 2020, and it applies regardless of where the rubber is processed.
Correct. It follows the commodity through the supply chain. And for Thailand, this is huge because rubber is by far the most significant Thai export affected. It represents something like 92% of all Thai exports to the EU that fall under the scope of EUDR. So, getting rubber compliance right is critical for Thai trade with Europe.
We initially thought this was going to hit the market earlier, but there was a postponement announced, right? Giving companies more time to get ready. What's the updated timeline now?
Yes, that delay was crucial. Implementation was postponed by 12 months, offering really critical breathing room for industries worldwide to finalize their systems. The regulation is now slated to be fully effective for large operators, which would include a company like NER on December 30th, 2025.
Okay, end of next year for the big guys.
Right. Small and medium enterprises, SMEs, get a little longer until June 30, 2026. This delay allows the entire Thai supply chain, literally from the individual farmer level all the way up to the processor like NER, to fully finalize its compliance procedures and traceability systems. They need to be able to prove the origin.
And the mechanism for compliance,
Yeah.
it's based on this really stringent due diligence process, isn't it? Tracking the rubber right back to the specific plot of land where the trees grew.
Exactly. You need geolocation data, proof the land wasn't deforested after the cutoff date. It's complex. But here's where Thailand seems to have a massive competitive advantage right out of the gate.
Oh, what's the advantage?
It's arguably Thailand's biggest strategic weapon in the global rubber trade right now. Thailand has been officially designated by the EU as a low-risk country for deforestation concerning rubber.
Low risk. What does that actually mean in practice?
It simplifies compliance dramatically.
Hmm.
Low-risk countries face only a 1% random physical inspection rate for their shipments at the EU border, and they're permitted to use simplified due diligence, which essentially means fewer supporting documents are needed to prove compliance compared to countries not deemed low risk.
Okay, 1% inspection sounds manageable. How does that compare to other countries?
Well, a country designated as standard risk, which includes many other rubber-producing nations, including, notably, Côte d'Ivoire, where NER is trying to expand, faces a higher 3% inspection rate. And more importantly, they face much more complex standard due diligence requirements, demanding more extensive documentation and traceability evidence.
Ah, okay. So this low-risk status dramatically reduces the logistical friction, the compliance cost, and the risk of border delays for NER and its compliant Thai suppliers compared to rival shipping from, say, standard risk countries.
Exactly. It creates a powerful, built-in supply chain differentiator for Thai rubber. Furthermore, Thailand is actually well positioned for physical compliance too, thanks largely to the centralized system run by ROT, the Rubber Authority.
How so?
Well, ROT has been registering farmers and mapping plots for years. It's estimated that Thailand has a high potential volume of EUDR compliant rubber ready to go, potentially reaching 2.3 million tons. That's nearly half, 48% of its total national production.
Wow. Where does that compliant volume come from?
It primarily comes from farms that already have proper land titles, have registered with ROT, and have provided GPS coordinates for their plots. This existing data provides the necessary traceability information that the EU regulations demand. Thailand had a head start on data collection.
Okay, that's a significant advantage. Let's talk about the economic impact then. Does being EUDR compliant immediately translate into a tangible financial benefit? Is there, like, a price premium? Or is it merely a defensive measure just to maintain access to the EU market?
It's actually both, but the immediate impact is the creation of what the market calls the EUDR premium. This regulation effectively creates value by segmenting the market. Compliant rubber, which requires all that extra verification, can trade at a premium price compared to non-compliant standard commodity rubber destined for other markets.
Interesting. How much was that premium initially?
When the regulation was first announced and compliant supply was perceived as potentially scarce, the premium was reportedly quite high. Sources mention spikes of up to 10 THB per kilogram early on.
10 baht a kilo. That's substantial on top of the base price.
Very substantial.
Yeah.
But as you'd expect, as the market adapts and more compliant rubber becomes available, especially from Thailand, that premium naturally decreases.
Right. Supply increases, premium shrinks.
Precisely. As the Thai supply chain geared up and proved its capability, the premium stabilized, settling around 2 to 3 THB per kilogram for a while. Then, after the implementation delay was announced, providing even more time for supply to adjust, it reportedly dropped further, maybe down to around 1 THB per kilogram more recently.
Okay, even 1 baht per kilo is still extra margin, right? Where does that premium go?
Critically, that premium still exists, and it should flow directly back through the compliant supply chain, rewarding both the processor like NER, who handles the certified product, and ideally also the farmer who provided the compliant raw material. It's a direct incentive for sustainability.
What are the sort of real-world economic projections for this premium across the whole sector?
The analysis suggests the projected benefits are quite tangible for the national economy. This EUDR shift is expected to increase average farmer income by about 0.8% in 2025 and potentially 1.4% in 2026, purely due to them receiving that EUDR premium for their compliant raw latex.
Okay, direct benefit to farmers.
And for Thailand as a whole, it's projected to increase the total value of rubber exports by 1.4% in 2025 and 2.5% in 2026. So it's a mechanism for creating additional economic value that's tied directly to meeting sustainability standards.
So in a way, this regulatory shift from the EU is almost forcing a strategic diversification away from just competing on price in the commodity race.
That's arguably the most significant long-term strategic benefit for a company like NER. EUDR forces a structural pivot. It pushes them away from relying solely on the low-margin, high-competition mass markets, mainly China, where pure volume and lowest price often dictate success. It directs NER's focus and investment towards premium, sustainable, and ultimately higher value markets like the EU. But also potentially other markets like India or South Korea, which often adopt EU-like standards if their manufacturers are supplying global automotive brands.
All right, those brands want globally consistent standards. Yeah. And this is where NER's existing commitment to ESG really matters, isn't it? They can use their sustainability credentials, their ratings, to help secure that premium positioning.
Absolutely. Their foundation looks strong here. NER has achieved the highly respected A rating in the SET ESG ratings for 2023. That's a good score. And they are also formally declared in Thailand's Anti-Corruption Progress Indicator program.
Okay, so they have the credentials.
This institutional commitment, demonstrated over time, positions them perfectly to leverage EUDR compliance not just as a costly defensive shield they have to have, but as an actual competitive advantage, an advantage that directly supports their strategy for maintaining and hopefully improving margins over time. They're investing heavily to increase capacity, just as this major regulation creates a premium market segment that's accessible only to compliant players like themselves. The timing is potentially very good.
So if we tie it together, the EUDR acts like a regulatory tailwind, pushing NER and others who comply away from being purely a commodity price follower and towards becoming a premium certified product producer. And this aligns perfectly with that small but strategic move they're making into value-added finished goods, like those specialized floor mats we talked about earlier.
It's a symbiotic relationship, exactly. Compliance becomes the prerequisite, the ticket needed, to access those higher value end users in demanding markets. And that access, in turn, helps protect them somewhat from the most volatile swings of the purely non-compliant commodity market. This strategic shift, driven by regulation but embraced by the company, is absolutely vital for securing market leadership and better margins in the next decade.
Okay, it's a compelling narrative. We've covered the short-term earnings pressure, the massive long-term capacity plans, and this huge regulatory tailwind from EUDR. Now let's try to tie this all together from an investor's perspective. How do analysts view NER's valuation right now, and what's the overall investment thesis that emerges?
Well, the analyst consensus remains strongly bullish, interestingly, which seems to reflect confidence in the underlying operational strength and that long-term growth strategy. They seem to be largely discounting the Q3 ASP pressure as a temporary cyclical issue.
Okay, what kind of price targets are they putting out?
The IAA consensus target price, looking forward into 2025, shows an average of 5.65 THB per share. The range is quite wide, though, stretching from a low of 4.50 THB up to a high of 6.40 THB.
So average 5.65, and the overall sentiment, the recommendations, buy, sell, hold.
It's almost unanimously bullish, actually. The consensus breakdown provided shows 100% bullish sentiment among the reporting analysts. Specifically, that was 6 buy recommendations and 3 hold recommendations. Crucially, there were 0 sell calls.
No sells at all. That signals pretty high conviction, doesn't it? Conviction that the underlying fundamentals, the capacity growth, the volume resilience, the strategic compliance with EUDR will eventually translate into strong future earnings and share price appreciation.
That seems to be the interpretation, yes.
Okay, let's discuss those valuation multiples then, because they look incredibly low, almost surprisingly low, for a company with such aggressive growth plans on the horizon.
You're right. The market has clearly not fully priced in that future growth potential yet, based on current multiples. NER is currently trading at very attractive, some would say cheap, multiples. The reported trailing price-to-earnings, or PE ratio, is strikingly low at just 4.8 times.
4.8x PE. That means the stock is trading at less than 5 times its current annual earnings. That suggests either the market thinks earnings are going to fall off a cliff,
or the stock is potentially fundamentally undervalued relative to its earnings power.
Right, and the price-to-book value, the PBV ratio, that adds to this undervaluation narrative too, doesn't it?
Absolutely. The projected 2025 price-to-book value is estimated at 0.97 times.
So less than 1, trading below book value.
Exactly. Trading below its calculated book value, theoretically, less than the net value of its assets if liquidated. Now, for investors, this can suggest market skepticism about the company's ability to efficiently utilize its current and future assets to generate adequate returns. But for a value-oriented investor, it signals potentially deep undervaluation, an opportunity if you believe in the strategy.
Okay, low PE, PBV below 1. But for many investors looking at a commodity processor like NER, the high dividend yield is often the primary attraction, right? Providing stability and income.
And NER consistently delivers a robust income floor on that front. It is universally highlighted by analysts as a high dividend stock. Looking ahead, full year 2025 dividend yield estimates are consistently in the high single digits. Different brokerages forecast yields typically ranging between about 7.6% and up to 9%.
Wow, 8-9% potential yield. That's very attractive in most market environments.
It is, and that high yield provides a strong cash return cushion for investors while they wait for the massive capital expenditure in SDR3 and that strategic EUDR pivot to hopefully yield their maximum earnings potential down the line.
And they also recently announced an interim dividend payout too, didn't they, for the first half of the year?
Yes, they did. An interim dividend of 0.05 THB per share for the first half of 2025 was announced. Based on the share price at the time, that equated to about a 1% to 1.1% yield just from the interim payment. The XD date, the date you need to own the stock by, was set for August 22nd.
Okay, and that commitment to regular interim dividends, even small ones, it helps maintain investor loyalty, doesn't it? And confirms management's focus on shareholder returns even during quarters where margins might be under pressure, like Q3.
It's a positive signal about their cash flow confidence and commitment to returns, yes.
Okay, so let's try to synthesize the final investment thesis here. We've got this picture of short-term volatility and margin pressure, which is very real, but it seems counteracted by massive planned capacity expansion and this potentially significant strategic advantage from EUDR compliance. How does this all translate into a unified argument for owning or considering NER stock?
Well, the synthesis that emerges, I think, is that NER offers a potentially compelling proposition specifically for investors seeking a combination of dividend and growth.
Dividend and growth, okay.
The Q3 profit pressure, as we discussed, looks like a temporary hit driven mainly by commodity price dynamics. But the underlying operational strength evidenced by that consistent 15% plus volume growth and the healthy year-to-date profit increase seems solid.
Right. The operational engine is running strong.
And the future growth drivers are very clearly defined now. You have the SDR3 expansion providing the sheer volume increase. You have the India market penetration providing necessary geographic and customer diversification. And you have the early and apparently successful adaptation to EUDR providing that crucial strategic competitive advantage.
Yeah.
An advantage needed for margin maintenance and accessing those premium regulated markets.
So, in essence, the argument is NER is offering a high dividend yield today, backed by operational stability that seems superior to some peers, while simultaneously investing heavily to transition itself from being just a high-volume commodity player into becoming a high-volume, compliant, potentially premium producer for the future.
Exactly. They are strategically positioning themselves, seemingly quite effectively so far, to thrive in what's becoming a more regulated, more fragmented global market. They're trying to use compliance not just as a cost of doing business, but as a competitive moat, a barrier to entry against non-compliant competitors. And that strategic positioning is the core reason underpinning the bullish analyst consensus and the dividend and growth thesis.
That was an extremely deep dive into Northeast Rubber.
Okay.
A lot to unpack there. We hope this extensive analysis covering everything from the short-term margin fight to that huge SDR3 capacity leap and the really critical strategic importance of the EUDR regulation helps you decide whether this particular rubber stock fits into your own investment portfolio, especially if you're looking for that potential mix of high yield today and future growth tomorrow.
Indeed.
If you have any questions about NER or perhaps would like us to analyze a specific different stock in a future deep dive, please do let us know in the comment section. We do read them.
And perhaps, as you reflect on NER's path towards sustainability and these premium markets, consider this one final, maybe provocative thought about long-term sustainability. While EUDR compliance absolutely gives Thailand, and by extension NER, a critical short-term premium, and it buys them valuable time to adjust, the ultimate long-term challenge for the entire Thai rubber industry, NER included, probably extends far beyond just meeting this regulation or the next one.
What's the deeper challenge?
The real battle, perhaps over the next decade, will likely be fought on fundamental production economics. It means not just producing certified compliant rubber, but finding ways to radically increase the yield per the actual productivity and output of the rubber plantations themselves. And also driving true value-added innovation, moving significantly beyond just intermediate products or simple industrial floor mats to genuinely secure market leadership against global competitors who are also rapidly adjusting and innovating. Compliance is the entry ticket, but innovation and yield optimization are probably the path to sustainable long-term dominance in this industry.
A crucial point. Compliance gets you in the game,
but efficiency and innovation keep you winning. Something to think about. Finally, don't forget to like, share, and subscribe to support our team here. Thank you for joining us on the Deep Dive.